The general accounting standard of lower of cost or market for inventories does not apply to property, plant, and equipment. Recall that inventory should be reduced to the lower of cost or market. Even when property, plant, and equipment have suffered partial obsolescence, accountants have been reluctant to reduce the carrying amounts of the asset, and the lower of cost or market rules that apply for inventory do not apply here. This reluctance occurs because, unlike inventories, it is difficult to arrive at a fair value for property, plant, and equipment that is not subjective and arbitrary. An impairment of long-lived assets occurs when the carrying amount of the asset is not recoverable, and therefore a write-off is needed. Various events and changes in circumstances might lead to an impairment. Examples include 1. A significant decrease in the market value of an asset. 2. A significant change in the extent or manner in which an asset is used. 3. A significant adverse legal change in legal factors or in the business climate that affects the value of an asset. 4. An accumulation of costs significantly in excess of the amount originally expected to acquire or construct an asset. And 5. A projection or forecast that demonstrates continuing losses associated with an asset. If events and circumstances indicate that the carrying amount of the asset may not be recovered, a recoverability test is used to determine whether an impairment has occurred. To apply the first step of the recoverability test, you estimate the future net cash flows expected from the use of that asset and its eventual disposition. If the sum of the expected future undiscounted net cash flows is less than the carrying amount of the asset is considered impaired. Conversely, if the sum of the undiscounted expected future net cash flows is equal to or greater than the carrying amount of the asset, no impairment has occurred. The recoverability test is a screening device to determine whether an impairment has occurred. For example, if the expected net future cash flows from an asset are $400,000 and its carrying amount is $350,000, no impairment has occurred. However, if the expected future net cash flows are $300,000, an impairment has occurred. The rationale for the recoverability test is the basic presumption that a balance sheet should report long-lived assets at no more than the carrying amounts that are recoverable. If the recoverability test indicates that an impairment has occurred, a loss is computed. The impairment loss is the amount by which the carrying amount of the asset exceeds its fair value. The fair value of an asset is measured by its market value if an active market for it exists. If no active market exists, the present value of expected future net cash flows should be used. To summarize, the process of determining an impairment loss is as follows. Review events or changes in circumstances for possible impairment. Next, if the review indicates impairment, apply the recoverability test. If the sum of the expected future net cash flows from the long-lived asset is less than the carrying amount of the asset, an impairment has occurred. If not, no impairment has occurred. Assuming an impairment, the impairment loss is the amount by which the carrying amount of the asset is greater than the fair value of the asset. The fair value is the market value or the present value. T. Simmons Company has an asset that, due to changes in its use, is reviewed for possible impairment. The asset's carrying amount is $600,000, which is calculated by subtracting the $200,000 accumulated depreciation from the $800,000 cost. The expected future net cash flows, undiscounted from the use of the asset and its eventual disposal, are determined to be $650,000. The recoverability test indicates that the $650,000 of expected future net cash flows from the asset's use exceeds its carrying amount of $600,000. As a result, no impairment is assumed to have occurred. The undiscounted future net cash flows must be less than the carrying amount for an asset to be deemed impaired and for the impairment loss to be measured. Therefore, T. Simmons Company will not recognize an impairment loss in this case. Let's assume the same facts as the previous example, except that the expected future net cash flows are $580,000 instead of the previous $650,000. Recall that the asset's carrying amount was $600,000. The recoverability test indicates that the expected future net cash flows of $580,000 from the use of the asset are less than its carrying amount of $600,000. Therefore, an impairment has occurred. The difference between the carrying amount of T. Simmons Company's asset and its fair value is the impairment loss. Let's assume this asset has a market value of $525,000. The impairment loss equals the $600,000 carrying amount less the $525,000 fair value to equal $75,000. The impairment loss is reported as part of income from continuing operations, generally in the Other Expenses and Losses section. This loss should not be reported as an extraordinary item. Costs associated with an impairment loss are the same as costs that would flow through operations and be reported as part of continuing operations. These assets will continue to be used in operations, and therefore the loss should not be reported below income from continuing operations. A company that recognizes an impairment loss should disclose the assets impaired, the events leading to the impairment, the amount of the loss, and how fair value was determined. Once an impairment loss is recorded, the reduced carrying amount of the asset held for use becomes its new cost basis. As a result, the new cost basis is not changed except for depreciation in future periods or for additional impairments. To illustrate, assume that N. Davis Company at December 31, 2002 has equipment with a carrying amount of $500,000 which is impaired and is written down to its fair value of $400,000. At the end of 2003, assume that the fair value of the asset is $480,000. The carrying amount of the asset should not change in 2003 except for the depreciation taken in 2002. The impairment loss may not be restored for an asset held for use. The rationale for not writing the asset up in value is that the new cost basis puts the impaired asset on an equal basis with other assets that are not impaired. What happens if the impaired asset is intended to be disposed of instead of held for use? In this case, the impaired asset is reported at the lower of cost or net realizable value. Because the asset is intended to be disposed of in a short period of time, net realizable value is used to provide a better measure of the net cash flows that will be received from this asset. Assets that are being held for disposal are not depreciated during the period that they are held. The rationale is that depreciation is inconsistent with the notion of assets to be disposed of and with the use of the lower of cost or net realizable value. In other words, assets held for disposal are like inventory and should be reported at the lower of cost or net realizable value. Because assets held for disposal will be recovered through sale rather than through operations, they are continually revalued. Each period, they are reported at the lower of cost or net realizable value. Thus, an asset held for disposal can be written up or down in future periods, as long as the write-up is never greater than the carrying amount of the asset before impairment. Losses or gains related to these impaired assets should be reported as part of income from continuing operations. You are now ready for a complete summary of impairments. The starting point is to look at events or circumstances that might lead to an impairment. If, based on all available events and circumstances, an impairment may exist, a recoverability test should be performed. Under the recoverability test, if the expected future net cash flows are less than the carrying amount of the asset, an impairment has occurred. If the expected future net cash flows are not less than the carrying amount of the asset, no impairment has occurred. When determining the impairment loss for assets held for use, the impairment loss is equal to the carrying amount less the fair value. For impaired assets held for disposal, the impairment loss is equal to the carrying amount less the net realizable value. For assets held for use, depreciation is based on the new cost basis, while no depreciation is taken for assets held for disposal. In addition, restoration of any impairment loss is not permitted for assets held for use, while restoration is permitted for assets held for disposal. Let's take a moment to review our discussion. The following questions will test your understanding of the material covered up to this point on impairments. Please select the best answer.